Okay, well, we are ready to start chapter 3. So just as a reminder, with the first project, you want to keep working on that. I think we have another work day. Let me look. Yes, next Thursday, we'll have a work day in class to work on Project 1. Project 1 is due October 10th, so you still have 2 weeks. So today we're going to talk about chapter 3, and then Tuesday we'll do examples on adjusting entries. So at that point, you'll be ready to finish the first project, okay? So what I really recommend, if you haven't already, would be good to make sure you've done the journal entries, page 5 and 6 of the journal entries on the project, post to the ledger, and do that unadjusted trial balance, okay? So that's where you should be. If you're not, you might want to work on that over the weekend and at least over the next week. And so then Thursday, you can work on the adjusting entries and the financial statements, okay? And that'll wrap up Project 1. Then we'll talk about chapter 4, and Project 2 is actually shorter. We'll do that after that. So just be kind of planning out your time there. So let's talk about chapter 3. So again, up until this point, we've covered part of the accounting cycle. We've learned to analyze transactions, journalize transactions, post to the ledger, prepare a trial balance, an unadjusted trial balance. So now we're going to learn in chapter 3 why we call that an unadjusted trial balance, because we're going to do adjusting entries, okay? So before we close out our books for the period, we always do what we call adjusting entries. Adjusting entries are always done like at the end of the fiscal year, okay? So we learned in chapter 1 that we use the accrual basis of accounting, which basically means we have to follow the matching principle and the revenue recognition principle. Well, if you remember those, basically what it stated is we need to recognize revenue in the period in which it was earned, okay? That doesn't mean we're getting paid for it in this period, but if we earned revenue, it must be recognized in this period. Same with expenses, right? If we incurred an expense, if we took on some expense, whether we're paying for it this period or not, we need to recognize that expense in the current period. So those are both generally accepted accounting principles that all publicly traded corporations have to follow. It's part of what we call accrual basis of accounting, that we're going to report accurately the revenues and expenses earned within the current period, okay? Again, it's not based on the cash received. It's based on whether the services were rendered or interest was earned, whatever the type of revenue was that was earned, okay? We don't use it in here, but the other form of accounting is cash basis of accounting. That is used for smaller companies, privately held. So it cannot be used if we're publicly traded. Cash basis is going to be used, and we talked about this, well, I don't know that we did, sorry. Confusing with my financial class. When I teach financial first, it's like, oh yeah, we didn't talk about that. I did, but y'all weren't there. So with cash basis, we're looking at a company that has like a small amount of customers that would owe them money. And maybe they do a lot of cash basis business anyway. So if I own my own lawn mowing company and say I mow like 10 lawns a month, half of my customers pay me cash when I actually perform the service, and the other 5 pay me later. It's pretty small operations. So cash basis of accounting would work in that type of operation. So cash basis means we recognize the revenue when we actually get paid. So that's the difference. Obviously, it's not GAAP compliant. We can't use cash basis accounting if we're a publicly traded corporation. But if we're, a sole proprietor partnership or even just a really small business, an LLC or something, we could use cash basis accounting. So under cash basis, I recognize revenue when I actually get paid. And I recognize expenses when I actually pay for them, okay? So it's just the opposite, okay? So all publicly traded corporations are required to use accrual basis accounting and follow GAAP procedures. Further, most large businesses, even if they're still privately held, are going to follow accrual basis accounting. It would just get messy and it messes up our financial statements. Okay. I just mentioned this, the revenue recognition principle. So again, that was one of the principles we talked about in chapter 1. So we're kind of going back. So we recognize revenue the day or the period in which it was earned. Okay. So it has nothing to do with when the customer pays us. And again, same with expenses. So we have the expense recognition principle. We usually call it the matching principle. Okay, any expenses earned in the current period need to be reported in the current period. Okay, so what this does, the whole purpose of this is we have an accurate picture of our revenue and our profit, right? Because if we're recognizing revenue when it's earned and expenses when they're incurred, when we do our income statement, we take revenues minus expenses, we have an accurate depiction of how much profit we actually made in the current period. So that's really why we do these adjusting entries and why it's important that we follow the revenue recognition and matching principle. So it's good to understand the why behind the adjusting entries. It makes them a little bit easier. So adjusting entries, the entries we do as adjustments are always going to affect a revenue or an expense. Okay? So you'll never have an adjusting entry without one of those two types of accounts. Okay. So we've done this already. We've done the unadjusted trial balance. So we did our journalizing and posting for the period and did an unadjusted trial balance. So we have all of these account totals. Okay. Many of the account balances on that trial balance are reported on our financial statements without any change. Like cash, for example. Cash will be cash at the end of the unadjusted trial balance. You won't ever adjust cash. Okay? However, we do have some situations where there have been expenses that have been incurred that we need to recognize, that we haven't recognized yet. Or there could be revenues that have been earned that we haven't shown and recognized yet. So for example, we've already dealt with supplies. Right? Remember in chapter 1 and 2, when we purchased supplies, it was an asset, right? We debited supplies and credited cash or accounts payable. As those supplies got used up, what did I have to do to them? What was a journal entry, or what happened when we used up supplies?
We debited supplies
Expense. Yeah, we expensed them off, right? Because we no longer had those supplies. Okay. That's an adjusting entry. So we've already actually done an adjusting entry. We just didn't call it that. But when we were at the end of the month and they told us, you know, we used up $500 worth of expenses or supplies, we debited supplies expense and credited supplies to show those supplies were no longer with us. They were no longer an asset. And that was important because we were showing there was an expense of the company. Okay. So that's one form of an adjusting entry. That's one that we do. Okay. We might also have stuff that we've paid in advance, like other prepaid expenses. So we've dealt with supplies, but we may have rent or insurance that we paid in advance. You know, what if we paid 6 months worth of rent? You know, we paid June 1st, we paid for 6 months worth of rent. Well, if we're at the end of the year, we've used up all of that rent now. When we originally purchased or paid for that rent, we debited like prepaid rent and credited cash. Well, now we've been in that building for all 6 months. It's all been used up. So we need to expense out that rent. Okay. That would be the same for insurance. So any prepaid expenses are going to be recognized as an adjusting entry at the end of the period. Okay. So that's sometimes just called like, you know, when we have revenues or expenses that are incurred as time passes. Okay. We also have like unearned rent or any unearned revenue. We've dealt with that. We dealt with that. We know unearned revenue was a liability, right? We dealt with that in chapter 2, where maybe we sold tickets in advance. And so we took the cash, we debited cash, and we credited unearned revenue. That was a liability. Well, in this year, if we actually had the concert and we provided that revenue, that service, now that's now earned revenue. Okay, so sometimes in the period we have revenue that we, that was actually a liability and unearned revenue. Now it's been earned. So we need to recognize that. And then there might just be some type of accrued expense or revenue that we just haven't recognized yet. Maybe we've been working on a job, on a service, and we haven't billed the client yet. Well, we need to recognize if there's any revenue that we've earned. Same with an expense. Okay, so we're going to look at these. So what we do is at the end of the period, we've done the journal entries, we've done the ledger, and now we've done the unadjusted trial balance. We're going to look at anything that has happened in the period that needs to be adjusted. Okay, so it's called the adjustment process or adjusting process. So we have to do journal entries, and they're just typical journal entries. You're still following debit, credit. It's just we're updating accounts that need updated. Okay. All adjusting entries affect at least one income statement account. Again, either a revenue or an expense. So every adjusting entry you have is going to affect either a revenue or an expense. And one balance sheet account. Okay, it could be a liability, it could be an asset, depends on the adjusting entry. Okay. So an adjusting entry will always involve a revenue or an expense and an asset or a liability. So if you're doing adjusting entries and you have an adjusting entry that's cash and accounts receivable, that's not including a revenue or an expense. So that's kind of your clue. Okay, I'm doing something wrong. Okay. If you ever have cash in an adjusting entry, just know cash is never going to be adjusted. Okay, so we have two main types of adjusting entries. We have accruals. We have both accrued expenses and accrued revenues. And then we have deferrals, deferred expenses or deferred revenues. Okay, so we're going to look at both types here. So an accrual is when revenue has been earned or an expense has been incurred, but we just haven't recorded it yet. Okay, so the revenue has been earned, the expense has been incurred, but we just haven't recorded yet. So again, for example, maybe we've been working on a service job. Maybe we do landscaping and we've been working on this project. So we've put in trees and we've cleaned out flower beds, but we're not finished and it's the end of the year. We're not getting the money yet from the customer, but we need to look at, well, how much revenue have we earned? Because we've provided service, right? So we would want to recognize that. Well, the accrual, when you have accrued revenue, is actually just a typical billing a client type entry. Okay, so this over here. So accruals. Okay, you have revenues. Okay, so an accrued revenue again is just earned but not recorded. So if a customer owes us for a service and we've earned the revenue, what would I debit and credit to show that a customer owes us for services performed?
It'd be debited accounts receivable, right?
Mm-hmm. Yeah, very good.
What's credited?
Just your revenue account. Yeah, so you're going to debit accounts receivable showing that they owe us money, right? And then it's the same journal entry if you bill the clients. That's really all it is. So your credit is going to be your revenue. Like fees earned, for example, usually. Okay. So you're just saying, I've earned this revenue and I need to recognize it. I'm not getting paid, so I'm debiting accounts receivable. So really, again, with an accrued revenue, it's just a typical, think of it like you're billing a customer. Okay. Okay, Okay, so that's the revenues. On the expense side, again, an accrued expense is an expense that's been incurred and we haven't recognized. So an accrued expense is one that has been incurred and not recognized. The most common adjusting entry for an accrued expense is going to be wages. Okay. So the best way to kind of explain this is, say we pay our employees weekly. We pay our employees every Friday. Great, right? They work Monday through Friday. We pay them like probably the next Friday, right? Because they have to have time to process payroll and everything. Well, what if your end of the year, your end of fiscal year falls in the middle of a pay week? It happens, right? I mean, we can't control when December 31st falls, and doesn't always fall on a Friday or a Saturday, unfortunately, right? That would make life too simple. So say the end of the year falls on a Wednesday. So you have a pay period Monday through Friday. You're going to pay that person the next Friday for Monday through Friday, okay? But they've worked Monday, Tuesday, Wednesday in 1 year. Thursday, Friday is a new year, right? So what we have to do is we have to look at Monday, Tuesday, Wednesday. Well, they've worked. I owe them wages. That's in this year. So that's an accrued expense. So when they've worked in the current year, we're not paying them until maybe January 5th or 6th or whenever the pay period rolls around. And we'll look at it like an example. But we actually owe that. We've incurred that salaries or wages expense. We're just not paying it yet. Okay? So an accrued expense, we're debiting some expense account. We're going to say wages, like wages expense, for example. And then because we owe them the amount, we owe them the payment, we're going to credit a liability, wages payable. It's like the transaction I gave you on the project, the 16th transaction. That's where that payable came from. I told you we'd talk about it in chapter 3. So hopefully that one will go back and make sense when we're done with chapter 3. You'll be like, oh, that's what we were doing. So wages that have been incurred, we owe them wages. We're just not paying them yet. But they happened in the current year. Monday, Tuesday, Wednesday, they worked, and it was this year. So we recognize the expense of those 3 days. Thursday, Friday, January 1st and 2nd are the new year. That expense will be recognized the next year. So it's not affecting how we're paying them. They're still getting their full week's pay whenever we run payroll. It only affects how we recognize the expense. Okay. So those are accrual. So these are your 2 types of adjusting entries for accruals. And there's a nice kind of what I just wrote on the board, right? So we have revenue has been earned. No journal entry has been made to this point. So at the end of the year, all adjusting entries are done the last day of the year. So these, if we ran on a January 1 through December 31st fiscal year, we would be doing all of these journal entries on December 31st. Okay. So at the last working day of the year for the period, it could be the month, but we'll look at it as a year. So we do those 2. For accrued expense, again, an expense has been incurred. We haven't recognized it yet. So we debit an expense account and credit a payable account, a liability. Okay. So again, accrued revenues, it's always going to be a credit to some revenue account. With accrued expense, you're debiting some expense account. So the rules of debit and credit are still the same. Expenses get debited when we incur an expense, revenues get credited. So remember that too as you're doing your adjusting entries. If you're dealing with revenue, revenue is always going to be the credit account. Okay. If you're dealing with expenses, expenses will always be the debit account. So with journal entries for adjustments, you should at least have half of it going in. If it's a revenue, you're crediting some revenue account. Okay. We can also have deferrals. So our other type of adjustments are deferrals. Okay. Number 3. Okay, so we could have deferred revenues, and we can have deferred expenses. Okay. So deferred revenue is a revenue that we are going to receive in the future. Okay. But if we actually receive, or if we actually provide that or earn that revenue in the current period, then we have to recognize it. So really, when we look at a deferred revenue, we're always dealing with unearned revenue. Okay, so deferred revenue is always unearned revenue. So at some point in the year, someone paid us in advance for services. So we debited cash and credited the liability unearned revenue. We sold tickets, cash was debited, unearned revenue was credited. Well, now we're at the end of the year, and we need to look at, well, out of all of that revenue that we owed, how much of it have we provided? Okay, how many concerts have been performed? Okay, so any that becomes earned, we're going to switch from unearned to earned revenue. So,
like on the thing we was doing yesterday, that goes to this, it was only saying like half.
well, it could be. It could be. We don't know. We have to figure out, how much has actually been earned. Because we could have sold tickets for concerts throughout this year and maybe next year, right? So we would look at, well, how many concerts have actually happened this year? That's the revenue I've earned this year. If it's a concert for next year, I haven't earned it yet. Okay. So we look at the portion, of the unearned revenue that has been earned. So in this case, your adjusting entry is always a debit to unearned revenue, that liability account. And then we just credit the revenue account because it's now earned. So deferred revenues, you debit unearned revenue and credit whatever the revenue account is, ticket revenue or whatever. Deferred expenses are all of your prepaid expenses. So deferred expenses are going to be like supplies, prepaid rent, prepaid insurance. So we've paid in advance, we've purchased supplies, we've purchased rent for several months, or we've purchased an insurance plan for several months. Okay, those are all prepaid expenses. So at the end of the year, we want to look at how many supplies have we used, how much rent have we used or has expired, or how much insurance has been expired. And we want to expense out what has been used. Okay, so you always debit an expense account. Supplies expense, rent expense, insurance expense. And you credit an asset. The asset depends on what's expired. So again, if it were supplies, we've already done that entry. We would debit supplies expense and credit supplies for supplies that have been used up that we need to expense out. If it were prepaid rent, we would debit rent expense and credit the prepaid rent account, which is an asset. And same with prepaid insurance. Okay. So that's a deferred expense. We've paid for it in advance. That's why it's deferred. We paid for the expense up front or prepaid it. And now we have to calculate, well, how much of it have we actually used up? Yes, ma'am.
Why the people pay in advance?
Well,
Just be ahead.
yeah, I mean, sometimes we get a discount for paying. Obviously, with supplies, you always are going to purchase those and then use them up. So, but with like prepaid insurance, if you pay like a 6 month premium, even personally, you usually get some kind of discount. So a lot of times they'll do that. It's a good question to get a discount, to save some money. Or some places, like if you sign a lease, they may require you to pay a certain amount, you know, of rent up front. So it's either a legal requirement or there's some kind of discount associated with it. Yeah, good question. So there's a nice slide kind of summarizing the deferrals. And here I like this slide because it shows you the initial journal entry too. Okay. So, you know, you probably wrote this in your notes, but you can always print off like just one slide if you want to and stick that in your notes. So it shows you initially with unearned revenue, cash was received and revenue was going to be earned at a future date. So we debited cash and credited unearned revenue, the liability. At the end of the period, all of that or some portion of that revenue has now been earned. It could be all, it could be a part of it. So for whatever portion that was earned, we're going to debit unearned revenue and credit revenue. And then for your prepaid expenses, same thing. You paid for a future expense, so you debited some prepaid expense, supplies, prepaid rent, prepaid insurance, and credited cash. And at the end of the period, well, how much of that have we used up? And we expense out what's been used up, and we credit the asset, the prepaid expense asset, to show it being gone and used up. Okay. Any questions so far? Let me see. I wanted to see. I'm going to skip through some stuff real quick because I wanted to talk about one other adjustment before we do examples. Where'd it go? Okay, here we go. I'll go back to some of that. I need to put this in a different order. The other adjustment, so these are the four main types of adjusting entries. We do have one final adjusting entry type, and that's for depreciation. What does depreciation mean?
Go down.
Right, it goes down, the value, right? Depreciation is the loss of value on something. So you buy a car. Is your car, maybe I paid $15,000 for my car. Is that car worth $15,000 after 2 years? No. So that's what depreciation is. Depreciation is kind of the decline in value, okay? So when we purchase what we call fixed assets or long-term assets, so we're talking equipment, vehicles, buildings, things like that. Those have an initial value, the cost that we paid. Over time, their value goes down. Wear and tear, you know, usage, they may break, whatever. But we're looking at, you know, just normal wear and tear. Okay, so these fixed assets that we use are going to depreciate over time. Okay, a fixed asset or a long-term asset is just one that we use for more than 1 year. Okay, so a building, equipment, vehicles, we usually use those. I mean, a building maybe, I think this building's been here for 50 years, you know, so it's a long time. It was one of the original buildings. Obviously, they've had to do some improvements, but you know, we've had this and used it in the college for 50 years. But like vehicles, equipment, maybe 3 years, 5 years, 10 years. You know, we're going to use them though for a long time to help us earn profits. So when we purchase an asset, we always debit the asset and credit like cash or accounts payable or notes payable or whatever. As that asset gets used up over time, we're going to expense out the use of that asset, okay? So if we have a vehicle, we paid $15,000 and we're going to use it for 5 years, we want to spread that $15,000 over all 5 years that it's helping us earn revenue. That goes back to that matching principle. So we purchase an asset, we're going to expense it over the life or the useful life of it, okay? Land is also a fixed asset. Does land depreciate though?
No.
No. Land never depreciates, okay? So when we purchase land, it goes on at the cost we paid, and it stays on our books at that cost until we sell it. But our other fixed assets or plant assets, we are only going to keep for a specific amount of time. So again, we're going to take the cost that we paid and spread it over the life of that asset. So fixed assets, besides land, depreciate over time. Every year or every month, every period, we're going to calculate that depreciation expense, okay? The good news is in this class, you won't have to learn the depreciation calculations. Like there's different types of depreciation, straight line, double declining, all these different ones. They'll just tell you, hey, this asset depreciated this much this year. Okay, so you kind of get off easy. In financial accounting, we get into all that fun stuff. Okay. So an adjusting entry for depreciation, we always debit depreciation expense. Depreciation expense. And the big kicker on depreciation is we don't credit the asset directly. Okay, we want to keep, say we bought equipment, that equipment's going to stay on the books at the cost we paid until we get rid of it. So we create a new account that's called accumulated depreciation. And that's the account that we credit. And we'll have an accumulated depreciation account and a depreciation expense account for every fixed asset we own. So if we own a vehicle, it would be depreciation expense vehicle, accumulated depreciation vehicle. So accumulated depreciation is what we call a contra asset account. Contra just means opposite. Okay? So accumulated depreciation is a contra asset account. I think they show us that, yeah. Okay. So assets increase on the debit side, right? Vehicles, land, equipment, all increase on the debit side. An accumulated depreciation is a contra asset account. Contra asset. So it increases on the credit side. Okay. It's really kind of like a placeholder or just a place to keep that depreciation that is accumulated. The accumulated depreciation has a normal credit balance. It's a contra asset account. So we'll have vehicle increase on the debit side at the cost that we paid. Accumulated depreciation on the vehicle will increase on the credit side and shows the decline in value over time. Okay. This is showing like an actual adjusting entry where we have office equipment that has depreciated $50 probably in the month. So we had $1,800 of office equipment debit. We debited depreciation expense $50 and debited accumulated depreciation $50. So that credit to accumulated depreciation is where we're showing that decline in value of the office equipment.
We have subtracted and put the new amount.
No, this stays its own account. So we just, every time we credit it, we're just showing the amount of depreciation that has accumulated, the total decline. So how that works though, when we're finished at the reporting side, on our balance sheet, we're going to list what we call the book value of that asset. Okay? That's where we subtract. So you're going to see office equipment or whatever minus accumulated depreciation. Because you have that debit and then that offsetting credit. Okay? So book value is cost minus accumulated depreciation. That's the value that it's worth at any given point. If you've ever looked at like Kelley Blue Book for a car or something like that, you know, that's kind of like the book value, what it's currently worth. Well, that's our book value. That's what it's worth to us. That doesn't mean that's how much we could sell it for or anything like that, but that's the value we have recognized, okay? So that's what's recorded on the balance sheet is the book value. You'll actually see office equipment less accumulated depreciation, okay, on your balance sheet. Okay, don't want to go through that yet. Any questions on that so far? So the ones I've written on the board are the types of adjusting entries that you're going to encounter, okay? So again, you can kind of easily see if it's an adjusting entry dealing with revenue, you're always crediting a revenue account. Again, with expenses, whether it's accrued expense, deferred expense, or depreciation, you're always debiting an expense account. Okay. So there's kind of like a template almost, you know, a guide. Well, let's look at some examples. Let me go back. Here. So this is just showing kind of our new chart of accounts where we've added some new accounts in. So we have an accumulated depreciation account now. We have wages payable because we have deferred expenses or accrued expenses. We have rent revenue is a possibility now. And then we have two new expenses, insurance expense and depreciation expense. That's just kind of highlighting. You've probably already seen some of these accounts on the project, and you may have been wondering, what do I do with that? Now we get to learn. Okay, so again, an example, we're up here, we're on accrued revenue. So an example of an accrued revenue says, assume that NetSolutions signed an agreement with Bankner Company on December 15th to provide services at a rate of $20 per hour. As of December 31st, NetSolutions had provided 25 hours of services. We're going to bill it January 15th, but we've already accrued some of this revenue. So we calculate how much. Well, $20 per hour, 25 hours. We multiply, right? 25 hours at $20 an hour. We've earned $500 of revenue that we haven't yet recognized. So that is an accrued revenue. So we debit accounts receivable, just like we do here, and we credit fees earned, that revenue account. So that's an accrued revenue. It kind of shows you, which I think is important, kind of what happens when we don't do these adjusting entries. You won't have to do this on the test or anything, but it's just kind of good to see and visualize and understand the impact. So if we did not recognize that $500 of revenue, revenue would be understated. So it'd be less than what we actually earned. Therefore, net income would be understated. Well, on the other side, on the balance sheet, assets would be understated because we didn't recognize that money due to us, that accounts receivable, which would then make equity overall understated. So when we don't do the adjusting entries, the kind of end game here is that our financial statements aren't accurate. And that is a violation of GAAP, okay? Because we need to report all the revenues and all the expenses in the period. So what's the end game here? Well, if your net income were understated, your tax liability would be lower, which then the IRS is not happy. Okay. Plus, we're not accurately reporting our assets. That might tick off our stockholders because the company looks like it's worth less, right? Because the equity is understated. So these have like effects other than just on our bottom line. Okay, they have ending effects. Accrued expenses. So NetSolutions pays its employees bi-weekly, so every other week. During December, NetSolutions paid wages of $950 on December 13th, and then they paid wages again of $1,200 on December 27th. As of December 31st, Net Solutions owes $250 of wages to employees for Monday and Tuesday, December 30th and 31st. Again, we're paying them every 2 weeks, so we still have 8 other days of pay to accumulate before we pay them. But those 2 days are in the current year. So that $250 needs to be recognized as an expense in the current year. So accrued expense. So we debit wages expense and we credit wages payable. We're paying them at a later date. So that's a liability. We owe them those wages. But we'll pay them when we have a normal pay period day. And we won't focus on this too much, but it's just showing you the journal entry when we actually paid them on January 10th. So as of January 10th, we're paying them for the full 2 weeks of wages. So we had all wages, total paid was $1,275. That was the full wages for 2 weeks. We've already recognized $250 of that for those 2 days in last year. So we're debiting the liability account to show that we've already recognized that expense and now we're paying them. So we're debiting the liability to clear it off. And then we debit wages expense for the remaining amount. So that was the entry you had in your project, right? You had an existing wages payable of like 120 and you had to do this journal entry, okay? It's kind of showing you here. I think it's a little bit better of a visual representation of why that's happening. So they worked on the period from December 2nd to the 13th. They worked those 2 weeks, they got paid. They worked the 16th through the 27th, full pay periods, they got paid. But those next 2 weeks, the 30th and the 31st were in year 1, and January 1st through the 10th was in year 2. That's why we had to recognize these 2 days of pay in year 1. Okay? So sometimes it's just easier when you can look at it on a calendar and see what's going on. Again, we won't go into this too much, but if we don't recognize that expense, our net income is overstated. So we're showing a more profit than what we actually earned in the period. Our liabilities are understated, which causes our equity to be overstated. So both income and equity are overstated. Well, then our investors and everything think we made, this is only $250, but think of a major company, those wages could be a lot more, 10 times, 20 times, whatever. So what may only look like $250, what if it was $200,000? Maybe not that much, but you get the point, like it could be a big issue, okay, that we're overstating our income. Okay, so those were both the accrued revenue and expense, the examples. Then we get into deferred expenses. Okay. Here, again, with the deferred revenue is always an unearned revenue. So December 31st, unadjusted trial balance indicates a balance in the unearned rent of $360. So that's when someone's paid us in advance. We've rented out a building. We earn revenue by renting out buildings, whatever spaces. They paid us in advance, so we took cash debit and a credit to unearned revenue, unearned rent revenue. Now some of that rent has been earned. So we had a balance in the unearned rent of $360. This balance represents the receipt of 3 months rent on December 1. Okay, that was for December, January, and February. So at the end of this year, only 1 month of rent has been earned. So we took $360, divided it by 3 months, so $120 has been earned. So on these, on the deferrals, a lot of times it's just calculating the amounts. So we debit unearned rent, which is our unearned revenue account, and we credit rent revenue for 1 month that we've now earned. Okay. Again, in this case, our net income and our equity would both be understated. just like they were when we had an accrued revenue. Okay, the overall effect is the same. So it's a problem if we don't do that adjustment. Prepaid expenses, again, we've dealt with supplies before. So they're showing us, you know, we had total supplies during December was 2,000. We purchased 2,000 of supplies. When we counted at the end of the month, we only had $760 worth of supplies left. So when they tell you what's left, you have to subtract to calculate what was used up. So when you're doing supplies, just make sure you know, are they giving you what was used up or are they telling you what was left? If they told me we used 1,240, that's my adjustment amount. If they tell me how much was left at the end of the month, I need to subtract to get my adjustment amount. Okay. And again, we've already done this journal entry in chapter 2. So we debit supplies expense and credit supplies for the supplies that were used up. We need to expense them out. Okay. So supplies expense debit 1240, supplies credited 1240. And when we do that, we balance supplies, the new amount is 760, which is what they told us we still had left. Prepaid insurance and prepaid rent really work the same, so we'll do more examples on Tuesday in class. Talked about that. So at the end of the chapter, there's a nice summary of all the different adjusting entries, which is pretty cool. So again, print those out, you know, use them in your notes, use them working on the project, on the homework, because it tells you the example, the reason for the adjustment, the adjusting entry, and then the examples that they gave you in the book, okay? So those are really great slides to just kind of go back to, so you can say, okay, I've read through this adjusting entry, what's happening? Match it up to one of these, then you know what to do. Okay, so those are accrued revenues and expenses. They also have the deferred revenues and expenses and depreciation. So all 5 of them are there in the PowerPoint. Print those 2 pages off. This is what your adjusting entries look like in your journal. They're really, the only difference is on your journal, you're going to put the words adjusting entries centered, and then you just enter in all of your adjusting entries. Again, they're all dated December 31st. Other than that, they look the same as any other journal entry, right? You have your debit and then your credit. And then they have the description, which you know you don't have to do on the homework. Okay? So there's all the adjusting entries for the period. On your ledger, this is when we would start using that item column. So you'd actually type the word adjusting when it's an adjusting entry, just so we can identify what kind of entry it is. Other than that, though, your ledger does the same thing. If you debit an account, you need to log that in that ledger account. Okay. So there they're showing accounts receivable was adjusted with a $500 debit, so it has a new balance of $2,720, and so on and so forth. So we journalize all the adjusting entries and we post them to the ledger. The only difference is we put the word adjusting in the item column. That's showing all of them. And then you do an adjusted trial balance, which is on your project as well. It's just like an unadjusted trial balance. You just have new balances, right? You've adjusted some accounts. Okay. Cash was the same. It didn't get adjusted, but we did see adjustments to like accounts receivable, supplies, and prepaid insurance. Land will never get adjusted. And office equipment will never get adjusted. But we do see that adjustment for the accumulated depreciation on the office equipment. Accounts payable and wages payable, I know we adjusted wages payable. We also adjusted unearned rent. Common stock and dividends, did those get any adjusting entries? No, so those won't see adjustments. Fees earned could, rent revenue could, those both did. And then a lot of your expenses did, right? Wages, supplies, rent, insurance, depreciation, those could have all had adjusting entries, okay? So again, to do an adjusted trial balance, it's the same as an unadjusted one. You just have new account balances. Okay. That's really it, right? So chapter 3, again, is really just focusing on adjusting entries. It is a little tricky. I don't know why, but it seems to trip students up, especially in the the calculation. So, really review it and go over it. Print those slides that have the summaries on it. I want you to understand the why behind it, and then it makes it easier to do the adjusting entries. We do adjusting entries in financial accounting too, so it's good to try to get a grasp of it now. So Tuesday we'll do examples together on each 5 types of adjusting entries. Thursday we'll have a project work day. So we'll be working on, you'll do the adjusting entries on the project, you'll journalize them, post them to the ledger, and do your adjusted trial balance, and that will finish off project 1. Okay. At that point, we'll be ready to do what we call the closing process in chapter 4. Okay. It's actually just 4 journal entries. And then we do our statements at that point. Okay, so project 2 is going to do a closing entry process, statements, and then we're done. Any questions? All right. Well, y'all have a great weekend. Be working on project 1 if you haven't gotten to the unadjusted trial balance.